Welcome back to the deep dive. We've just come through a really packed 7 days. Monday, October 27th, right through to Monday, November 3rd.
Yeah, it was a week defined by tension, really. And the main story was definitely, like you said, the Fed cuts, the Fed speaks. What made it so tricky was the economic picture going in. The data was, well, profoundly mixed. You had these sort of flashes of okay-ish consumer strength right alongside signs of pretty deep and persistent weakness in industry. That created a genuine dilemma, I think, a really foggy decision environment for the central bank when they met midweek.
That fog analogy is perfect because looking at the data, it almost feels like two different economies running side by side. Let's start with the consumer, right? That's most of the U.S. economy. Last Tuesday, we got the Consumer Confidence Index. Came in at 94.6%, just nudged past the expected 93.4%. So the headline number maybe sounded okay, but you dig a little deeper, and that number tells a genuinely worrying story, doesn't it?
It really does. We've got to remember, beating expectations when expectations are already pretty low doesn't exactly signal real strength. It was still lower than the previous month's reading. But the number you really need to keep in mind is this. The index is still almost 30% below where it was pre-COVID back in 2019.
30%. That is a huge gap. It suggests that, consumers might be resilient enough to beat a forecast by a point here or there, but fundamentally they're operating under this sustained sort of structural malaise compared to 4 years ago. It's just hard to build solid economic growth on that kind of shaky foundation.
Exactly. And if the consumer is showing that level of insecurity, well, manufacturing is showing outright decay. Let's look at the ISM Manufacturing Index. That came in weaker than expected, 48.7%, missed the 49.5% forecast.
Right. And what's interesting there is that 48.7%, it marked the first decline after 3 straight months where the index had actually been ticking up just slightly. We had those 3 months of, I guess, tentative hope, and this one reading just wiped them out.
And that hope was always pretty fragile, really, because the context is just brutal. This reading. It's the 8th straight month of contraction in U.S. manufacturing. The sector's been shrinking, not growing, for almost 3 quarters now. But zoom out further, it's even more alarming. 34 of the past 36 months have been in contraction territory.
Wait, hold on. 34 out of 36 months. So we're talking nearly 3 full years of pretty much continuous decay in industrial output, bar a couple of blips.
Well, it certainly raises deep questions about the real health of the productive economy, beneath the surface of maybe okay job numbers. And making all this even murkier is the elephant in the room.
Yeah.
The ongoing government shutdown.
Yeah, we're now 34 days into this thing, just 1 day short of that record from 2018-19. It's not just a political headline anymore. It's a real economic factor.
Effects are becoming quite palpable now. We're seeing issues with funding delays for things like the food stamp program that immediately hits consumption. We're seeing actual disruptions to air travel processes right before the big holiday travel season kicks off. That's a significant economic input. And crucially, this shutdown is making things genuinely difficult for the Federal Reserve itself.
Yeah.
Well, because the Fed relies heavily on key reports, the monthly jobs report, CPI inflation data, to make informed decisions about interest rates, looking ahead. And those reports, they're being delayed because of the shutdown.
Yeah.
So when Chairman Powell and the governors met last week, they were essentially flying partly blind, missing some of their most crucial instruments.
Which sets the stage perfectly, that sort of caution, for the Fed's actual action last Wednesday. They did what everyone expected, cut rates by 25 basis points. But like we said at the top, the action wasn't really the story here. The language was.
Absolutely. The market had totally priced in that quarter-point cut. But the comments from Chairman Powell that followed, they were immediately read as much less dovish, much less accommodating than traders had hoped for. He brought in this stark, kind of unexpected note of caution, basically telling the market, hey, don't count on another cut in December.
Yeah, he used that great analogy, the one about the fog, to explain how the Fed was thinking. He said, and I'm quoting here, "What do you do when you are driving in the fog? You slow down." There's a growing chorus now of maybe this is where we should at least wait a cycle.
Exactly. And that phrase, wait a cycle, that was the key bit.
Yeah.
It instantly signaled that the Fed was maybe less worried about keeping the easy money flowing and more concerned about making a policy mistake because the data was so foggy, so mixed, and because of those shutdown-induced blind spots.
And that fog analogy, that caution, it hit the market hard and fast. What was the immediate sort of measurable impact?
It was pretty dramatic, actually. Before Powell spoke, the market probability of seeing another rate cut in December is practically a sure thing, around 93%. After his statement, that probability just plummeted to 67%.
Wow.
Yeah, that's a huge drop in certainty in, maybe half an hour?
Yeah.
It immediately reset market expectations for the rest of the year.
You see an immediate reaction in bonds, right?
Exactly right. Bonds sell off because, well, they become less attractive compared to the prospect of higher rates sticking around. The bond market quickly adjusted to that less accommodative future. We saw the yield on the 10-year Treasury, which moves opposite to the bond's price jump, 10.9 basis points pretty quickly. It closed the week at 4.11%. That move is basically the market translating Powell's caution directly into a higher cost of borrowing across the whole economy.
Right. Now, that leads us straight into the stock market because the Fed's caution sort of slammed right into this pre-meeting optimism that was building. The S&P 500, growth stocks, the NASDAQ, they all hit fresh record highs on Tuesday. But then, poof, that momentum just evaporated after the Fed meeting.
Yeah, and we need to look at how things sold off to see where the real pain was. Small cap stocks, they're super sensitive to borrowing costs and rate changes. They sold off 2.0% for the week. Value stocks also got hit pretty hard, down 1.7%. Their valuations are often tied more closely to interest rate expectations than, say, big tech.
So the parts of the market most sensitive to the cost of money reacted strongly to Powell's foggy outlook. And yet the big indexes, large cap stocks down only 0.3%, growth stocks actually up 0.3%, NASDAQ up 0.8%. They managed to mostly shrug it off or even gain ground. That points straight to the real driver in the market right now, doesn't it? AI.
Precisely. I mean, earnings season has generally been strong, most companies beating expectations. But AI is just, it's the only story that seems to matter for huge capital flows right now. The stock market's kind of running on two tracks. The broader economy is maybe contracting, the Fed's nervous. But the AI revolution, that's just charging ahead full speed.
Okay, and this brings us to what feels like the core aha moment of the week. This great paradox of capital expenditure, or CapEx. 5 of the Magnificent 7 tech giants reported earnings, and all of them announced these massive AI investment plans, more spending, more CapEx, building more data centers. Historically, that kind of announcement was just uniformly rewarded by the market. But this time, the reaction was completely mixed.
That mixed reaction, that's the big shift. You had companies like Meta and Microsoft report solid earnings, but their stocks dropped sharply. Meta fell, 15.1%, Microsoft down 2.7%. Meanwhile, Amazon was up almost 12%, Google up over 5%. So why the difference? Everyone's spending billions on AI infrastructure. Why the different treatment?
Before we solve that mystery, we absolutely have to mention the biggest winner from all this, NVIDIA, the company making the chips that power this whole revolution. It became the first stock ever to cross $5 trillion in market value this week. It gained 8.0% just by announcing a bunch of new AI partnerships. Its own earnings aren't even out until later in November.
Yeah, that just shows the sheer power of the narrative right now. But back to the paradox, why the mixed reaction for the big spenders. The reason was really nailed by Alan Bond over at Jensen Investment Management. He offered this insight, saying, this is the first quarter we've seen where more CapEx wasn't uniformly rewarded. There's more focus on return on invested capital.
Wow, okay. That feels like a seismic shift. So wait, does this mean the days of just announcing you're throwing billions at data centers and getting an automatic stock bump? Those are over. The market's stopped just taking this spending announcement itself as proof of future success.
Seems like it. Yeah, the market's matured. Maybe. It's basically saying, okay, thanks for spending the money, but now show us the plan. Show us how you're going to monetize it.
But stepping back just for the immediate term, there is a powerful counterforce pushing back against any worry that growth stocks are getting, too overheated. And it's simply seasonal optimism.
Yeah, the calendar is definitely on the market side right now. If you look back historically, November and December have just been fantastic months for stocks. Since 1940, November ranks as the second best month on average, and December is the absolute best for average returns.
And Sam Stovall at CFRA reminds us of that old saying, gains beget gains. In years where the market is already up a lot through October like we were this year, up almost 18% in 2025, you typically see even better than average performance in the last 2 months. So yeah, historical momentum is definitely fighting against that economic caution we talked about.
Okay, moving quickly to global markets then. Developed market stocks were down a bit, shed about 1.2% for the week.
And what's driving that decline, given all the mixed signals?
Mostly the U.S. dollar, actually. Powell sounding less dovish, reducing the odds of a December cut that tends to strengthen the dollar. And a stronger dollar makes dollar assets more attractive compared to others, so it puts some pressure on developed market stocks outside the U.S. Emerging market stocks, meanwhile, they managed to stay pretty much flat for the week, down just 0.1%.
But internationally, we did have two major standouts just continuing their runs, driven by specific local factors.
That's right. Japan hit another record high, gained 3.8% as investors sort of extended the celebration from their recent election results, which seemed to promise continued stability and monetary support. But the real headline grabber was Argentina. That market absolutely soared, up 22.8% just for the week.
Wow. 22.8%.
Yeah, which means it's up almost 50% since its own election, as investors are betting really heavily on a future of, well, economic deregulation and major reform. That kind of single-week move is just extraordinary.
So, okay, let's step back and try to connect the dots from this really pivotal week. The core tension seems pretty clear.
Yeah.
You had this grinding drag from the cautionary economic data, that persistent manufacturing slump, the 30% gap in consumer confidence we talked about, and yet that was consistently kind of offset by seasonal market strength and this relentless, maybe now more critically viewed, rise of the AI stocks.